In this chapter, we're going to look firstly at the principles of marginal costing. Now, marginal costing differs from absorption costing because it's based on a principle where we're only going to charge variable production costs to our cost units. Our fixed production costs are going to be attributed to the relevant period, and they're going to be written off in full against what we call the contribution for that period. Now, it's also got implications for inventory valuation because our inventory is only going to be valued at variable cost. That is going to have an implication for our cost of goods sold and also for our statement of financial position. Section 2 introduces the idea of contribution. Contribution is a really important concept in marginal costing, and it's one that we're going to use quite a lot as we go through this particular paper. Contribution is simply the contribution towards fixed costs, and when fixed costs are covered, profit, and it's calculated as the selling price per unit less all variable costs per unit. If we're looking at total contribution, it's quite simply the total sales revenue less the total variable costs. If we look at a simple example, let's just say we've got product S. It's got a selling price per unit of $20. Total variable production costs are 12 and variable selling and distribution costs are 4. Now, if we wanted to work out the contribution, then each one of these units that we sell, well, we've got a total variable cost of $16. So if we sell one of the product S's at 20, each of the products is going to incur a variable cost of 16, and that means that the contribution is therefore $4 for each unit. Now, that contribution is firstly going to cover any fixed costs that we might have, and when we've covered all the fixed costs and we've broken even, we're then going to be into a situation where it's going to increase our profit. So after we've covered fixed costs, then our profit is going to increase by $4 for every additional unit of product S that we sell. What's important to realise, however, is that although the total variable cost is used to work out contribution, i.e. we're going to include non-production variable costs in our total variable cost there of 16. If we're looking at a marginal costing system and we want to value our closing inventory of product S, then we're only going to include the production variable costs. So they would actually be valued at $12 per unit and not $16 per unit. If we look at the income statement pro forma using marginal costing, we can see it's structured differently than it was when we actually did this using absorption costing. In absorption costing, the split between the top half of the statement and the bottom half of the statement was production and non-production costs. This is different. The top half of our statement, right the way down to contribution, is going to be our sales minus our variable costs. The bottom half is going to be to take off our fixed costs. So the emphasis between top and bottom is variable and fixed, and not production and non-production. Now, the key points to note from this statement is that our cost of sales calculation is similar to what it was when we did absorption costing, but we're now going to value our inventory at marginal cost. So that's going to be the variable production cost only. And our production costs themselves are only going to be at variable cost. So again, variable production cost. Now, before we actually get down to contribution, which is something that we don't see in absorption costing, there we would normally have gross profit, but here it's contribution, we're going to take off any other variable costs that are not production costs. Finally, we take off all our fixed costs and we end up with our profit figure. These production fixed costs down here, under absorption costing, would have been absorbed into our production cost. But here we're going to write them off in full against the contribution for the period. In lecture example 1, we've got the same data as we looked at when we were doing absorption costing. Given to us again here, and we've got our information about our variable costs again, our production and sales units, as well as the activity levels for years 1 and year 2. What we're required to do is to complete the income statement for both years under marginal costing principles this time, and we've got some working papers in respect of year 1 to complete as well. So let's start off with the easy bit first. Let's start at the top with our sales figures, and we'll do that for year 1. Selling price per unit is $10, and in the first year we actually sold 4,200 units. So 4,200 multiplied by 10 gives me sales revenue of $42,000. So now we move on to the cost of sales, and we're only going to be looking at variable production costs. Now we're told that there is no opening inventory, so there's no value to put in there, but we need to complete the working papers for working 1 to work out what the production costs are going to be. Now we can see that our actual production in year 1 was 4,400 units. Now our total variable production cost is the direct materials, labour and production overhead, and that gives us a total of $6 per unit. So let's complete working 1. We've got 4,400 units at the marginal cost of $6, and that gives us $26,400. So that needs to go in our production. We need to take off our closing inventory, and that's going to be valued at marginal cost only. Now, if we produced 4,400 and we sold for 200 and we didn't have any opening inventory, well, that allows us to calculate the value of our closing inventory, and we'll do that in working 2. So we've got no opening inventory. We made 4,400, but we need to take off what we sold, which is for 200, and that gives us 200 units of closing inventory. Now, those 200 units we're going to value at the marginal cost per unit of 6, which we've just calculated, and that is 1,200. Notice that we didn't include the selling and distribution cost there because that is not a production cost. So the valuation of inventory, we're only looking for our production variable costs. So that gives us a total cost of sales Okay, let's do year 2. So this time we've sold 4,000. So 4,000 multiplied by 10 will give us sales revenue of 40,000. We've got some opening inventory this time, which is actually our closing inventory from year 1. So it's going to be $1,200. And the production costs, well, this time we've produced 3,800 units. So 3,800 units at a marginal cost of 6 is equal to $22,800. So let's pop that in there. We've got 22,800. Now, how many units of closing inventory have we got? Well, we started off with 200 opening. We made 3,800 more, but then we sold 4,000. So we actually have no units of closing inventory, so there's no value in there. And that all comes to 24,000, which is our cost of sales. If our sales are 4,000, that means that we've got 4,000 as our variable selling cost this time. And that means when we take both of those away from our revenue, we're left with 12,000 contribution. After fixed costs, which are the same as period 1, we end up with 1,500 in terms of profit. In the next section, we're going to have a look at the effect of inventory valuation on profit. Let's consider the cost of goods sold. In the cost of goods sold, we bring forward our opening inventory, we add our production cost, take off our closing inventory, and that equals our cost of goods sold. Now, if we're going to value our inventory differently in absorption costing and marginal costing, it means that different amounts are going to be brought forward and carried forward to different accounting periods. And that means that the profits are going to differ when we've got a change in inventory levels. Now, the amount that we charge to our production cost is going to be the same because in absorption costing, we put the cost into our units, and in marginal costing, we charge it in full, but just further down the income statement. So the difference in the profits between absorption costing and marginal costing is going to be down to this change in inventory. Examination questions may require you to reconcile two profit figures, one that's been produced using absorption costing and another one that's been produced using marginal costing. Now, the difference between those two profit figures can be reconciled by working out what the overhead absorption rate is per unit and then multiplying that by the movement in inventory. So that's going to be the difference between our opening inventories and our closing inventories. Now, don't worry too much at that point whether the inventory is going up or down, but that's going to be the difference. Then when you're trying to think about, well, which way does it go, sometimes it can be a little tricky to try and think through, well, what's being carried forward and brought forward into the cost of goods sold. So there is a little way we can try and make this a bit easier and remember which way it goes, and that's by using this little mnemonic SIAM. And it simply stands for stocks increase, absorption more. So if stocks are increasing, absorption profit will give you more than marginal costing profit. Let's have a look at lecture example 2. Lecture example 2 requires us to do a reconciliation between two profit figures. So using absorption costing, the profit figures that we produced for years 1 and 2 were 2,500 for year 1 and 1,100 for year 2. Now we're going to reconcile those to what we've just done in our example, in lecture example 1. So let's jot those down. So in year 1, under marginal costing, we had to $100, and year 2, we had $1,500. So you can see that we've got $400 difference between the profits in year 1, and we've got $400 difference between the profits in year 2. And we know this is because the difference in our inventory. So how are we going to reconcile it? Well, there's a couple of ways we can go about it. The first one is to use a little pro forma like this. So we start off with our absorption costing profit, which we've put in here. We're then going to add any fixed overhead which is in the opening inventory. Now, in year one, we didn't have any opening inventory, but what we did have is 200 units of closing inventory. Now, if you remember, each one of those closing inventory units had $2, which was our overhead absorption rate per unit. So we've got 400, which is in our closing inventory, and if we take that off, it means that we come back to our marginal costing profit of 2,100. Let's do the same for year two. This time we're going to bring forward the 400 because that's in our opening inventory, so it's brought into the cost of sales, and we didn't have any closing inventory, and therefore we end back at the marginal costing profit of 1,500. Now, a quicker way to do this might be to actually think, well, what's going to be the change in our inventory? And here we had a change in inventory of 200 units. We know that the profit difference is going to be that multiplied by the overhead absorption rate, and we knew that was 2. So we know that in year one, our profit difference is going to be $400. Then all we do is think, well, let's go through SIAM. Are stocks increasing or are stocks decreasing? Well, in year one, our inventory was increasing because we started off with 0, we ended up with 200. And that means that absorption costing profit will be higher than marginal costing. And we can see, therefore, that the marginal costing profit figure is going to be 400 less than the absorption costing. In year two, it's the other way round. The stocks are actually decreasing, and therefore the marginal costing profit is going to be higher than the absorption costing profit. And you can see that that's the case in year two. Let's use that method in lecture example 3. So we're told when opening inventories were 8,500 litres and closing inventories were 6,750 litres, a firm had a profit of $62,100 when they used marginal costing. Assuming that the fixed overhead absorption rate is $3 per litre, what would be the profit using absorption costing? So the first thing to do here is to think, well, what is my change in profits? And I can get there by looking at my change in inventory level and multiplying it by my overhead absorption rate, which in other questions you may have to calculate from the budgeted information. Here we don't know, we've been given it, and it's actually $3. The difference between our opening inventory and our closing inventory is 1,750 litres, and that means that if we multiply that by 3, we've got 5,250, which must be our change between the two profits. Next, we either need to think through what's happening to cost of sales, or we need to use SIAM in order to come up with the actual answer. Now, we've been given the marginal costing profit, so we need to think, well, what direction has the stock movement been in? If we started off with 8,500 litres and we ended up with 6,750, then that means our inventory has gone down. And it's gone down, meaning that this case, marginal costing is going to give us a higher profit than absorption costing. More has been brought forwards into the cost of sales from opening inventory than has been transferred into the next period in our closing inventory. And therefore what we can do is we know that we've got 62,100 under marginal costing. If we take off 5,250, we end up with 56,850. And that's going to be our absorption costing profit, which is answer B. Finally, let's look at the advantages and disadvantages of marginal costing. what we've seen is that contribution is calculated, and contribution is something that we can actually control in the short term. So it's very useful for decision making because it highlights that contribution. A lot of the things that we take into account under absorption costing, things like fixed production overheads, your rent, rates, salaries, we can't actually control those in the short term. So they're not relevant in the short term for decision making. And therefore, what we'll see is that most decision making techniques we use in management accounting use marginal costing. The other second point here is about, well, fixed costs actually, most of them are period costs. If we look at something like rent, rent is normally an annual payment or a monthly payment or maybe half yearly. But they are related, it is a cost that's related to periods. And therefore what we're doing is we're treating it in accordance with that, in accordance with their nature. You could argue that absorption costing is trying to force something that's actually a fixed cost into becoming a variable cost by trying to put it into our cost units. So by writing it off in full against the period, then that's a much more realistic way to deal with it. It also means that profit depends on sales and efficiency. In other words, lowering our costs and trying to sell as many units as possible. What we saw with absorption costing is that it was possible to build inventory and in doing so make our profits much higher for that current period by taking effectively costs into the next period. So that profit manipulation isn't possible under marginal costing. And we'll also see that when we do some variance analysis, it's slightly simpler. So what about the drawbacks then of marginal costing? Well, if we use marginal costing to set selling prices, which we'll see later on that we can do in certain situations, then if we continue to do this in the long term, we would fail to cover all of our fixed costs. So this is an area that we'll be looking at in a little bit more detail later on. We're also going to not comply with international accounting standards if we use marginal costing systems, and that means that we're going to have to do some year-end adjustments that are going to be quite timely to do and really quite unnecessary if we just used absorption costing in the first place in order to prepare our financial statements. We also have to analyse what we call mixed costs, or sometimes called semi-variable costs. So if we've got costs which have an element of fixed and variable cost associated with them, then in order to get to contribution, we've got to pull out the variable element of that cost. Now that means that we might have to use techniques such as what we call the high-low method, or maybe regression. And these are techniques that we're going to look at later on. And the final disadvantage, that if we are in a seasonal business, then there can be some profit variances from each period to period because of those seasonal variations.
One of the reasons why companies want to work out the cost of producing a unit under either marginal costing or absorption costing is so that they can use this to determine the price to charge for the product. Cost plus pricing, the idea then of working out the cost to produce the product and then adding some kind of profit markup that's required to the cost, is a very common pricing strategy. What we're going to think about then is the advantages and disadvantages here of using absorption costing or full cost production, that would include activity-based costing, to work out the price of the product, or just looking at the variable cost, the marginal cost of producing one more unit. So starting off then thinking about the full costing approach, this is where we've used absorption costing and an overhead absorption rate to determine the total cost of producing a unit. If we use this approach then, the biggest concern is that it's failing to recognise that there's a relationship between the price and the quantity demanded. With normal goods then, if you increase the selling price, as a general rule, the quantity demanded will decrease. If we just add a total cost then to the price of a unit, we're failing to take that into consideration. And after the price has been calculated, it will still need to be adjusted to reflect what consumers are prepared to pay and also the market conditions. So thinking about what competitors are charging. So what we've got here is a starting point, but it's not necessarily going to give us the end price. The other thing that's very key is that budgeted output volume is needed to be established, because that's going to affect the overhead absorption rate and the number of units which the overheads will be charged against, and therefore that's going to have a direct impact on the number of units produced, and also it's going to have a direct impact on the selling price through those number of units. If we remind ourselves of the formula for the overhead absorption rate, I can explain that more fully. So if you have a look then, I've just jotted down the formula for the overhead absorption rate. So my little example here, quite an extreme one, if they're unsure whether production volumes are going to be 1 million or 2 million units, then that's going to have a massive impact on the amount of fixed overheads that get charged to the product and also the ultimate selling price. What that's going to mean then is it's really important, if the company uses full cost pricing, that they try to predict volume as accurately as possible. Once they've predicted the volume, then they need to try and make sure they've got a suitable basis for absorbing the overhead. So that might be using labour hours if it's a labour intensive process, or machine hours if it's machine intensive. In some situations it might be more complicated than that, and that's why activity-based costing could be used. Despite the problems then of using full cost pricing, it's widely used because of the fact that it's quite quick and simple, and therefore cost effective, to add a percentage to a price that's been calculated through what one would hope was a fairly rigorous process. This is particularly important for companies whereby there's lots of individual jobs and lots of prices have got to be decided and quoted on each day. We don't want there to be a huge amount of expert skill needed. It also means then that you can vary the profit margin, and so as long as we are getting those predictions right about output and volume, then it should ensure that the price charged covers all of the fixed costs and enables the company to make a profit. If we're concerned about all of the difficulties with working out the full cost using absorption costing, then the alternative could be to use marginal cost pricing. The idea here then is that because we're not taking the fixed overheads into consideration per unit, then the markup will need to be higher to ultimately try and cover those. Again, it's fairly simple and easy. In fact, it's even easier than absorption costing because you don't need to work out the overhead absorption rate per unit. The markup, as before, can be varied, which means that you can have adjustments depending on the market conditions, competitors, etc. The other thing is it's much more useful for short-term decision making because it draws attention to contribution. By undertaking to sell this product, we're working out how much extra contribution there is towards the fixed costs, which ultimately have to be paid regardless of the volume of output, and therefore it directly relates to what the increase in profit should be. So as you can see here, we've got an example. If a product costs has unit costs of $10 and a markup of 150%, then that's going to get to a selling price of $25 per unit. If they manage that, then they're going to be able to get $15 of contribution. However, if the selling price changes, then the amount of contribution will also change. So in practice then, this is used quite a lot because there will be a readily identifiable variable cost. So in retail, for example, it's the saying, shops will know exactly how much they're paying for the goods that they're buying in, and they'll be able to add a percentage to the purchase cost. There are, however, disadvantages of using marginal cost pricing, although it relates to relevant costing and the variable costs incurred. It does mean that, again, it's not paying enough attention to the market conditions, to what competitors are offering, and to overall profit maximisation. So yes, we can vary the markup, but we still have to go and get that external information and often make a final adjustment. It's fine to think about contribution in the short term, but in the long term, if a company fails to cover its fixed costs, then it's not going to be profitable.
In section 6, we're going to look at a different concept of contribution, and that comes through in something called throughput accounting. Now, throughput accounting really developed from something called the theory of constraints that had its foundations in manufacturing. And this theory of constraints really led to the development of throughput accounting. So what's the theory of constraints all about? Well, what it's about is maximisation of something called throughput. It basically said that what's important in a business is to maximise the rate at which we earn sales while we keep our costs to a minimum. And the costs that it specified here were conversion costs, which are labour costs and overhead costs, and also investment costs. Now that sounds fairly sensible. What we want to try and do is make as many sales as we possibly can for as little cost as we possibly can, keeping the amount of money we have to spend to on things like machinery and premises to a minimum. And that means that is going to maximise our profit. Now, what the theory of constraints also identified, though, was that sometimes that there is a little bit of a problem with this. And this is because of what we call bottlenecks in the production process. In other words, something is going to act as a barrier to maximising that throughput. Effectively, something was always going to be the slowest process, or something was always going to slow production down. And that's going to stop us earning our throughput. So the theory of constraints is all about, well, how can we actually address bottlenecks and try and manage and minimise them? And if we can do that, we can actually maximise throughput and maximise profit. This is actually illustrated quite nicely in this diagram. Let's just say that we've got 3 processes that go into the manufacture of a product. So we've got materials preparation, component preparation, and then final assembly. Now we've got raw materials going into these processes, and finally we've got sales at the end. Now if we look though at the capacity of each of these processes, we can see that materials preparation and final assembly can actually deal with 100 units an hour. But for whatever reason, component preparation can only deal with 50. Now, we call this the bottleneck, and that's going to slow everything up. It's sometimes also known as the binding constraint, because it's a thing that's actually going to limit activity. Now, what's going to happen here is materials preparation is going to chug along at 100 units an hour, and work in progress is going to build up just before components preparation. Now, along with work in progress comes some holding costs. So it's not desirable to actually have a lot of work in progress here. So what we need to do is address this bottleneck and say, well, how can we increase this from 50 units of an hour up to 100? But we also need to think about how we can get rid of this work in progress, because it's just going to cause us unnecessary expenditure. And one way that we might do that is temporarily slow this process down to operate at the same pace as what component preparation is operating at. And that way we're not going to have that additional holding cost. Now, Goldratt came up with 5 steps for dealing with the bottleneck activity. So the first step was to identify the binding constraint or the bottleneck. So here we've got component preparation, and that's just going to be done by observation, presumably within the factory, and saying, well, what's the slowest process here? What's actually going to be the thing that's holding up everything else, that stop us generating our throughput? What we're then going to do is make sure that we exploit the bottleneck or binding constraint. In other words, we're going to make sure that we get the highest possible output from it. Now, if that thing's going at the slowest, then we never want to hold up that process in any way. Now, for that purpose, we should have a buffer inventory just before the constraint. And that means that even if they start to go a little bit faster, they can do because they've got some units to work on. Once we've managed that, we're going to subordinate the processes before the binding constraint to operate at the same speed. And this is all about this prevention of a build-up of work in progress. Not only is it going to cause holding costs, it's also going to perhaps cause some deterioration if we've got something that's perishable, and maybe some idle time. And effectively, it's going to cause delays to the customer. And then we get to work on the bottleneck. So we elevate the bottleneck activity. How do we do that? Well, what we need to do is improve its efficiency and maybe put some more resources into it. So maybe we put some more workers in there, some more labour. Maybe we have to do some maintenance on our machine, or maybe even buy a new machine in order to elevate this bottleneck activity. Now, once we've done that, we basically go back to the beginning, because now that one's no longer operating at the slowest, another process will be operating at the slowest. So what we do is we do it again with the next bottleneck. If you think back to total quality management means continuous improvement. This is quite a good way of continual improving, because we're looking at weaknesses or bottlenecks within our production systems and continually looking at how we can address them. We're continually elevating the bottlenecks to make the systems more efficient, and therefore the maximization of throughput is going to be achieved. So throughput accounting then is based on this theory of constraints. It's very similar to marginal costing, but we tend to use it for longer-term decision-making about production capacity. Now, in order for it to work effectively, we need there to be a just-in-time environment. If there are no bottlenecks in the process, then just-in-time can actually work very effectively, because it means as soon as a customer places an order, then the processes that need to happen can be put in place in order to effectively deliver that thing to the customer as quickly as possible. Once we start getting bottlenecks in the process, then it means there's going to be delays, which is not going to be good. So just-in-time is really necessary here. So what are the key principles of throughput accounting? Well, first of all, we've got this idea of throughput. Now, throughput is basically maximization of sales and minimization of cost. We'll look at in detail a little bit more about what we mean by throughput in a moment or two. Inventory minimization is also important, and of course here we've got our JIT systems which back that up, and cost control. The lower the cost can be, the higher the profits, the higher the throughput. Now, the key principles to remember is the first one here, which is about the only variable cost being materials. Throughput accounting adopts the attitude that the only truly variable cost within production is actually the materials cost. If you think about it, labour in the real world really is a fixed cost, isn't it? Because most people are paid a salary, and that salary is an annual amount that people get paid probably monthly, and it's no way related to the amount of units of production. So treating labour as a variable cost will sometimes result in us making wrong decisions. So when we calculate contribution, we're actually going to call it throughput return. So just think of it the same as contribution, but the definition is slightly different. And effectively what it is the sales revenue but minus the materials cost only. So if you have questions that ask you to do calculations with contribution, just make sure you read them carefully. Is it talking about throughput contribution, or is it talking about normal marginal costing contribution? The second principle is that producing for inventory is bad. So we shouldn't make products unless there's a customer for them. And that means that we do need to accept some idle time in non-bottleneck operations. Remember that in bottleneck operations, we shouldn't have any idle time because we need to elevate that bottleneck and make sure it's going as quickly as possible. In terms of inventory valuation, our inventory is going to be valued at materials cost only. And that means that we're not going to add any value until we actually sell a product. So there's going to be no point actually making more inventory because it's not going to have any effect on profit. And that means that our profit is really going to be determined by how quickly we can actually turn our raw materials into cash. In other words, how quickly can we sell our goods, taking off, of course, the cost of actually getting them there, which is really just going to be materials. One of the important principles of throughput accounting is really quite a straightforward one. We can look to see how a product is performing by comparing the returns it delivers to the costs incurred in producing it. Now, clearly, we need the returns to be greater than the costs, and we can measure that by something called a throughput accounting ratio, or a TA ratio. Now, all the TA ratio is just the return divided by a comparable cost. Now, to do this, we've got a number of formulae to help us. So let's have a look at these next. Okay, now these look a little bit complicated, but really they're not. Let's start with the last one, which is the TA ratio itself. Now, remember I said that we're going to have the return over the cost. Let's just call that the throughput return over the throughput cost. And all we're doing really is comparing the two things. We need this to be greater than 1 in order for a product to be viable. Now, there's no point comparing a return for, say, a month and the cost for, say, a week. So a comparable amount of time has to be given to each of these elements. And that's why we've got here per factory hour on the top and on the bottom. But we could have per week, we could have per year, etc., etc. As long as we had exactly the same time period on the top as the bottom, then we're going to get a comparable TA ratio to work with. So we're looking for that to be greater than 1. And if it's 1 or more, then it's going to be viable. So let's just assume that this is actually per factory hour that we're dealing with here. What are the other formulae for? Well, if we look at the TA ratio, then we've got the throughput return on the top. Now, the throughput return, the top part of this, is the first formula here. This is how to calculate the throughput return per factory hour. So all we're going to take is the throughput return for 1 unit, and we're going to divide that by the hours to produce 1 unit on the bottleneck resource. So this is a little bit like the contribution per unit of scarce resource, once we've identified what that is. Now, the third formula there is the bottom part of the formula. So the throughput cost per factory hour, again, is the total factory cost per period divided by the total bottleneck hours per period. So we're going to here get a cost per bottleneck hour. And that total cost per period is the total of your fixed production costs and your labour costs. So how can we use throughput accounting for decision making? Well, we've mentioned already that we need this TA ratio to be greater than 1. In other words, that the return is going to be greater than the cost. Now, when we've got scarce resources, we need to prioritize those products that are going to give us the best return for each unit of scarce resource that we've actually got. And we're going to be looking at that later on. We can also rank our products by our TA ratio. In other words, we can have the best performing products given priority. Now, if we've got products that are made in the same factory as each other, then it means that the factory costs are going to be the same. So we can actually make our job a little bit more straightforward by ranking them simply on the return per factory hour. Now, we've seen when we looked at absorption costing that if we use reported profit as a way of evaluating performance, then inventory building is not discouraged, because the more inventory we build towards the end of the period, the more fixed overhead is going to be carried forward into the next period's cost of goods sold, and therefore increase the profit for this current period, and therefore performance will be measured more favourably. Now, this is completely at odds with the just-in-time philosophy, where purchase and production costs should only be incurred if there's going to be an immediate return generated. In other words, if we've got a sale which is imminent. Now, if we use the TA ratio in order to performance evaluate, then this is going to hopefully solve this problem, which we're going to look at in the next lecture example. Lecture example 4. EG produces 3 products, E, F and G. Now, the bottleneck resource is machine Y, which can be operational for 8 hours a day, and the conversion costs are $320,000 per day. Remember, that's our labour and our factory costs, our production overheads. Now, we've been given the selling price and the materials cost per unit. We've also been given the output per hour on machine Y. So what we're going to calculate for each product is the throughput return per unit, the throughput return per hour, the throughput cost per hour, and then finally the TA ratio. So what we're going to do is basically calculate this, working out the throughput return per hour and taking that over the throughput cost per hour. So firstly then, we need our throughput contribution, which is our selling price minus our materials cost. So for E, we've got 140 minus 95, which is 45. So let's pop that down here, 45. For F, we've got 220 minus 130, which is 90. And for G, 170 minus 120, which is 50. Now, we can't just take this contribution over the cost because we've got a bottleneck. So we have to think, well, how much contribution are we going to get for every unit of bottleneck resource? In other words, hours on machine Y. So we've been given how many hours we can actually produce on machine Y. So let's pop these in. We've got 800, we've got 500 and 1100, and we can produce that amount per hour. So in a total hour, the total throughput return that we're going to get for E is the 45 multiplied by the 800, which is 36,000. For F, it's going to be 45,000, and for G, 55,000. Next, we need to work out the conversion cost per hour, and we're told that we've got 320,000 conversion costs every day, and there's 8 hours in a day. So every hour, there's actually $40,000 incurred in terms of labour and overheads. So that means if we complete that, it's going to be the same for all 3 products. All we need to do to calculate our TA ratio is divide the return by the conversion cost. So 36,000 divided by 40,000 is 0.9. 1.13 for the next one, and finally 1.38. In part E, we've got to think about each of these statements and tick all that apply. So let's look at the first one. Product E is not currently viable. Well, product E has got a TA ratio of 0.9. Now that means that for every hour it's costing $40,000, but the return is only $36,000. Now that doesn't make good business sense, and the TA ratio is less than 1, and that demonstrates that actually it isn't viable. Product F should be made before product G. Well, let's compare their TA ratios. Product F has got a TA ratio of 1.13 and product G 1.38. Now that means that product G is actually generating $1.38 for every $1 cost, and that means that that's more than product F is. So actually this is wrong, because the other way round is the true answer. We should make product G before product F because it's got a higher TA ratio. Now if we increase selling prices of all the products, will it improve their TA ratio? Well, the answer is, well, yes, of course it will, because if we increase our selling price, it's going to increase our throughput contribution. So it will increase our TA ratio. And cost reduction will also increase the TA ratio. Again, it's going to increase that throughput contribution if it's material cost, or it's going to reduce the conversion cost per hour if it's overhead or labour cost. So either way, it's going to reduce the cost and therefore increase the TA ratio. So 3 out of the 4 statements there are correct. So how do we actually identify what is the bottleneck resource? Well, in the exam you might have to identify the bottleneck resource by calculating a machine utilisation rate. Now we can do this quite simply by taking the hours required to meet the maximum demand on a particular machine and dividing it by the hours available. Now if you've got more than one machine, if you compare the utilisation rates of all of them, then the bottleneck is the one with the highest utilisation rate. In other words, the one potentially working the hardest. So in lecture example 5, we're going to calculate some utilisation rates. Now this company has got 3 products, X, Y and Z. And they use 3 different machines to manufacture them, machine 1, 2 and 3, and the requirements have been given to us. We've also been given the annual demand in units and the maximum capacity in hours of each of the 3 machines. So we're going to calculate the tables and calculate the utilisation rates and then identify which of those 3 machines is the bottleneck. So let's take machine 1. Well, to calculate the first product, X, we need to take the demand and multiply it by the requirement. So on machine 1, for X, it's going to be 5 multiplied by 1,000, so it needs 5,000 hours on machine 1. Now, machine 1 then is also used to make product Y, and that uses 4, so by the time we've made 1,500 units, that's going to have used 6,000. And this one takes 3, product Z, so that's also going to be 6,000. So if we total that up, we end up with 17,000, and that's how many hours it would take on machine 1 to make the maximum demand of all those 3 products. If we do the same for machine 2, we've got 2 multiplied by 1,000, which is 2,000. 1,500 multiplied by 2.5, which is 3,750. And 2,000 multiplied by 1.5, which is 3,000. So machine 2 requires 8,750 hours. And then finally machine 3, we've got 1,000, there's only 1 hour there. We've got 3 hours, so that's 4,500. And then finally 8,000. So a total of 13,500 8,000 hours. Next, we need to look at the capacity. Now, the capacity of each machine is given to us in the question. So we're going to calculate the utilization rate, and we're going to take the maximum needed to get to demand and divide it by the capacity. So 17,000 hours is what we need, 15,000 is what we've got. That gives us 113%. Machine 2, well, we need 8,750, but we've got 8,500, which is still more, and that's 103%. And machine 3, well, we need 13,500. We've actually got 14,000, and therefore that is 96%. Now we've got two machines which are actually potentially working over the limit here, but the one with the highest utilization rate is machine 1, and therefore machine 1 is the bottleneck machine.